Hello Sector Watchers, welcome to the show. This is the 181st episode of Sector Spotlight. For when? Usually I would say for the Tuesday after the Monday that I'm recording this. And this Monday is Monday the 26th of June. And we have gone a new route and went YouTube only, so no more live stream, and that means no more scheduled and stacked shows. So my goal, I still need to find some sort of a new routine, I guess, but my plan is to record Sector Spotlight, to keep recording Sector Spotlight on the Mondays, but not after the close of the US markets, but maybe before or like today, during the start of the market. So right now it's 5 p.m. for me, so market in US is open for an hour and a half. Just to give you an idea, markets are, well, kind of unchanged. Anyway, that's the idea, so let's see how that goes, and hopefully this show will be uploaded on this Monday, so you will get it actually on the Monday. What it also means is that I am not restricted or tied to the 30-minute blocks anymore. And maybe you haven't noticed, but for me it's a good thing, because sometimes I just didn't have enough material to fill 27 minutes, that was the cutoff time. And I sort of started dragging out some stuff just to fill that gap in time. But in other occurrences, I need a little bit more time. Maybe I could have gone 35 minutes or 40 minutes, which I couldn't do because we had that 30-minute block that we needed to stay within. That is now gone, so be prepared for a little bit more flexibility, hopefully. And maybe I could even do 2 shows in a week if something comes up or a special event is there. Or one thing that I can imagine is when the month ends and I will do my review of the completed monthly bars. I used to have to wait until my next show to do that. With this new setup, I can do a quick show going over the monthly bars on the last day of the month. So I think it's only good things. Anyway, my name is still Julius de Kempenaer. I'm presenting to you from Amsterdam in the Netherlands. My addresses are on the screen, my social media handles. You can still reach out, you can still write me an email. I'll try to do my best to reply to everybody. Today's show is going to be about seasonality. Not because it's the last Tuesday of the month, that's tomorrow, but because it's the, let's say, the week before the new month starts. And I'd like to take a look into what the seasonals are telling us for the new month and how that aligns with the current rotations that we see in the various sectors. Ladies and gentlemen, this is Sector Spotlight. Here is the spreadsheet with the seasonality data, the data for the seasonality over the past 20 years. And as you know, the column for SPY, that's the market, that's in absolute terms. And all the columns for the various sectors are based on a relative versus the S&P 500. So what can we learn from this? What are the big takeaways? Well, the first thing, which I think is very interesting to see, is that for the market itself, for SPY, the month of July is actually one of the strongest months in the year over the past 20 years. April was the strongest together with November. And then we've got May at 75 and we got July at 75%. 75 means 75% of the time the S&P closed the month of July higher than it opened. Then it's a positive month. And if you look in the table below where we have the performance, and again for S&P that is the price performance, that's the absolute performance. For the sectors it's the relative performance versus the S&P 500. And if you do a quick analysis of this line, and that's interesting because the S&P in price terms gained 2.3% on average over the last 20 years. If you look at all the relative returns, And then minus 2% for the energy sector is the most negative relative return. That means that the energy sector was up 0.3% on average versus the S&P on average. So versus the S&P 500, that is minus 2. But in price terms, even the energy sector with the weakest relative performance was up 0.3%. That's how you need to read this line. Now if we go to the sectors, then there are a few that are standing out. Communication services to a degree, but really technology at 70%, real estate at 65%, and then consumer discretionary again at 60%. And then on the other side, there is really only healthcare at 40%, which is the reverse of that 60, as you know. All the others, 45, 50, 45, 45, 45, that's all a bit like flipping of a coin. So where do we need to concentrate? We need to concentrate definitely on the technology sector, real estate, and maybe communication services and consumer discretionary. If we look at the accompanying performance numbers, then communication services is only marginally outperforming the S&P 500, or at least that's the expectation. If we go to technology, that's 80 basis points over the S&P 500. So that's a pretty good sign. So we've got a high number in the expected outperformance, and we've got a high number in the performance column itself. And then we've got real estate, which is a high number or a relatively high number in terms of outperformance. And we've got 1.5% over the S&P 500. That's really strong. So we need to look at that. And then we have consumer discretionary with an expected outperformance of 0.4% over the S&P 500. And then healthcare is expected to underperform the S&P 500 by 40 basis points. So the sectors that I want to dive into with you for this show are, we're going to take a look at the S&P 500 itself, we're going to take a look at communication services, we're going to take a look at technology, we're going to take a look at real estate, and we're going to take a look at healthcare and consumer discretionary to see how the current rotations are fitting in with these seasonal expectations. Let's take a look at the RRG for asset class rotation. With the takeaway from the previous spreadsheet where we saw that the S&P 500 over the last 20 years, 75% of the time had a strong month of July with an average return of 2.3%. When we look at the rotation for the various asset classes, and that's the RRG that's on the left of your screen here, and let me toggle off Bitcoin because it's still a bit distorting, and we look at the rotation for the S&P 500, then we can see that it is at a nice strong heading between 0 and 90 degrees, pushing into the leading quadrant. And if you look very closely, you can see that that last week was kind of sideways, kind of stable, and that magnifies on the daily, where you can see that the tail for the S&P 500 was coming slightly down, but it's only coming down on the vertical axis on the RS momentum scale. And to me, that tells me that it is a loss of relative momentum, not necessarily a loss of relative strength versus VBINX, which is the benchmark that we use in this case. So combining that with what we see on that table with the expected seasonal performance, this temporary setback on the daily, but especially the strong tail on the weekly RRG, I think that the current rotation for the S&P 500 pretty much fits very well with the expectations based on seasonality for July. Let's take a look at the price chart itself. Here is the weekly S&P chart. We've been monitoring that overhead resistance area around 415 and then again in 425. And 2 weeks ago we had the break higher, and then last week was an inside bar, and then This is what happened today, what market is currently opening. That's right here. I don't see any problem here. We've seen the breakout. We're kind of setting back, and I'm watching that 420, 27, 428. This is what's that area? 424.79. That's the peak of this bar here. I'm watching that as a new support level. And even if that gives way, there is 415, 416, which we could do without harming that series of higher highs and lows that's underway since early October last year. So all in all, the chart of the S&P 500, in my opinion, looks pretty good. If we apply that 2.3% expected gain, average annual gain for the month of July, and take that from, let's say, 433 times 1.023, then you come to 443, which is pretty much the high that we've seen a couple of weeks ago. And if I look at this chart, to me, that looks absolutely doable. As a matter of fact, it's only a small jump. I am much more looking for the S&P to move into the resistance area between, let's say, 447.5 and 452.5, around that 450 area. I think that's much more of a resistance area than that previous peak at 443. But even if we only get to that previous peak, we're still fulfilling the expected target return of 2.3% based on historical data. If we look at the daily chart for the S&P 500, that's magnifying what we just looked at on that weekly, things are kind of the same. You can see how there was a little bit of a hesitation around 425, 426, that resistance level that we pointed out on that weekly chart as well. And we're coming off that recent high downwards now. And again, that 425 area, that cluster of prices here, and then again around 415, these are pretty solid support levels. Not too worried about that. Maybe a healthy setback, but the S&P 500 is still on the way up. If you look at the bigger picture here, there's still higher highs and higher lows in the making. 450 is the more serious resistance area, if you wish. And the RRG is pointing to an outperformance for the S&P for stocks over other asset classes. And the S&P itself is looking pretty strong. As I promised when we were talking about the sector seasonality, we're going to take a look at 5 sectors, probably, in relation to the rotations and their seasonal expectations. And these are communications. Let me do them in alphabetical order. The communication services sector, XLC, 60% of the time it had a positive return. It outperformed the S&P 500 over the last 20 years. The average return was only 0.1%. If we look at the tail for communication services on the RRG, that is moving into the weakening quadrant. It has moved into the weakening quadrant out of leading. We all know that the communication services sector was one of the strongest sectors over the last couple of, well, it's already months, not only weeks, couple of months. If I look at the price chart here, that is still underway. That is still a strong chart. And if I look at the relative strength, that is still moving in a nice uptrend. Looking at the RRG lines, you can see that there is some temporary weakness sneaking in, and that's because of the pace of the rally, the pace of the gain in terms of relative strength is slowing a little bit. That's the nature of momentum. And that's what you see on this RRG. You see the tail of XLC moving lower. But when you put it in perspective of all the other sectors, XLC is still one of the strongest sectors. It's got a pretty high reading on the RS ratio scale. It's going through a little bit of a setback. So with that 0.1% expected outperformance is kind of in line with the S&P 500. I'm expecting a pretty good month for communication services, but not as a strong outperformer vis-a-vis the S&P 500. That's for communication services. The second sector that we were looking at is technology. 70% of the time, the technology sector outperformed the S&P 500 over the last 20 years. That is a solid number. That is a significant number. And the average outperformance was 80 basis points. Let's bring that into perspective with the tail on the RRG, which is right here. And let me zoom in a little bit, and you can see how that kind of hooked back up. So we went through a little bit of a corrective move, and then over the last 2 weeks, and then again this week, you see how XLK is hooking back up into that strong RRG heading. And if I look at the price chart in combination with the RRG and the relative strength, that underscores this hook. The price chart is definitely strong. We've been testing, playing around with that all-time high level over there, so that is a strong sign. And you can see that a similar thing is happening with raw relative strength, and that's pushing or dragging, doesn't matter how you look at it, those RRG lines higher. And you can see how that temporary loss of momentum, that dip in the green RS momentum line, seems to have now bottomed above 100 and starting to pick up again. And that's causing that hook back up to the right into the leading quadrant. So this current price performance and the current rotation is completely in line with the seasonal expectations. So for technology, it looks as if a good month is coming. That's for the technology sector. Let's look at the real estate sector. Real estate was up 65% of the time. We've outperformed the S&P 500 65% over the last 20 years. And the average return for the month was 1.5%. So these seasonal numbers, these historical seasonality numbers, they're quite promising. However, when I put that into perspective and align that with the current rotation and the current price chart, it makes no sense. Look at the tail here. It's one of the weakest sectors in the on the RRG. It's very low reading on the RS ratio scale, and it started to bend to the left again and start to lose momentum as well. And if you look at the price chart, you can see how XLRE is still inside that falling trend channel. We bounced off that falling resistance line, and if you look at the raw route strength line, that is a very clear downtrend. And it looks as if that relative momentum line has already started to show the first signs of a peak below the 100 line coming in. So with respect to the real estate sector, I don't think there is an alignment between the positive strength or the positive expectation from a seasonal point of view and the weak expectation as we see it on the current RRG and the current price chart. And then we have the healthcare sector, which had an outperformance over the S&P 500 only 40% of the time, which means that it is underperforming the S&P 500 60% of the time. And the average performance for healthcare is minus 40 basis points in July. And if I look at the tail of the healthcare sector on the RRG, then that completely aligns with a weak expectation for the healthcare sector. The tail is moving rapidly back down into the lagging quadrant at a negative heading. And if you look at the price chart, oh, this is healthcare. I need to go to, this was discretionary. I need to go to healthcare. If you look at the price chart, then you can see how the healthcare sector is moving more or less sideways without a clear trend. But the relative strength just broke below important support and is moving lower. And you can see how both RRG lines have put in a peak and started to accelerate lower. So from a seasonal point of view, this is concurrent, this is aligning with the weak expectation. So the weaker seasonal expectation is aligning with the weak expectation from the current tail on the RRG and the current price chart and the relative strength line. And then finally, we have consumer discretionary. And let me highlight that tail here. Here's consumer discretionary. And here is the price chart. And you can see how that tail is actually powering off into the leading quadrant at a very strong RRG heading. And that is completely acknowledged by or caused by the strength in the price chart, which is holding up very well. After a breakout, we're sort of hovering in this first resistance area. The next target will be around, and this high here is 173. And you can see how relative strength is breaking above its previous peak and how it's actually turning around this series of lower highs and lower lows in relative strength, and how that is picked up by the RSG lines, which the RS ratio line is steadily growing, and you can see how that RS momentum line has put in a new low and is now starting to pick up new strength and pushing XLY deeper into the leading quadrant. So for consumer discretionary, I can totally see a strong month ahead in July with a seasonal expectation of outperformance over the S&P 500 with an average of 40 basis points. So if we recap that, we've got communication services, which is sort of in line, not really any strong expectations there. We have real estate, which is sending us contradictory signals, so no expectations there. We've got technology, which is sending us a strong seasonal signal with a significant outperformance over the S&P 500, which is acknowledged by what we currently see happening on the price chart. We see in the healthcare sector an alignment of the weak expectation on the RRG and on the price chart with the weak expectation from the seasonality, so those are aligned, and the same goes for the consumer discretionary sector, where the current tail is moving into the leading quadrant, which is backed by a nice breakout in price, strong breakout in relative strength, and a positive expectation from a seasonal point of view, where the sector outperformed the S&P 500 60% of the time over the last 20 years with an average of 40 basis points. So all in all, probably the best opportunities in technology, in consumer discretionary on the upside, and maybe healthcare on the downside. And that wraps up this first, well, it's the 181st, but it's the first Sector Spotlight new style, YouTube style. As I said, I'm going to aim to publish weekly, preferably on Mondays before or during US market hours. And as always, your thoughts, ideas, and or comments remain welcome on either my email address or any of the social media handles. And for this week, I'd love to hear your ideas and your views on this new format, shorter, pointy, and maybe a little longer when there is enough to talk about or there are bigger subjects. This show is probably a little shorter than we were used to, but as you can see, for me, it would not make any sense now to keep on dragging out 3 or 4 or 5 more minutes to fill that 27 minutes. So I'm really happy with this new format. Let me know what you think, and I'm looking forward to seeing you again next week at a new episode of Sector Spotlight. Same time, same place.